I'm curious that when someone like Jensen Huang talks about NVIDIA's plans to work with Uber on self-driving technology, what kind of knock-on effect is there for other companies? How do you turn something that Jensen Huang says into useful insight for the industry at large?
Well, Happy New Year to you too, Scarlet. Thanks for having me. I think it starts for us where we think about what are the second order effects of all this training and infrastructure that's being put in place for AI. And as we started to look through really through the infrastructure and supply chain, you end up obviously at data centers. And then if you look within data centers, there's a lot of talk and a lot of ETFs focused on the top 5 or 7 stocks that are typically the semiconductor stocks that go into these data centers. But when you break down the actual kind of bill of materials or what's actually in a data center for AI, it's actually quite different than a regular data center. You've got massive memory need, you've got massive cooling need, obviously massive electrical power need. And one of the interesting tidbits that we dug up is that there's about 4 times the amount of fiber in an AI data center than there is in a typical data center. And there's a company like Corning that makes that fiber. So we built up an ETF that really reflects the entire supply chain around the AI infrastructure so that the average investor could get in and really benefit from where the profit pools are. The profit pools are generally in the supply chain, not in the end producers. And we wanted to make sure that we were tracking the right tech, finding some of these hidden gems, and then weighting it right in terms of the amount of upside there is in some of these stocks based on what is happening over the next 3 to 5 years in this infrastructure build out. That's really exciting.
So I'm looking at the ETF, AIS is the ticker here, and the top geography is the U.S., primarily because of NVIDIA. But after that, 16% is weighted in Taiwan, about 6.5% in China. That raises the question of tariffs and the risks of investing outside the U.S. when the U.S. has proven to be such a haven over the last couple of years.
Yeah, I think the U.S. is clearly a big market where there's a lot of investment happening. But as you mentioned, there is investment happening in other geographies. And Asia is not going to be left behind in this AI race. And they're building AI infrastructure as fast as we are. And so we wanted to reflect the international footprint of the supply chain, not only for U.S. Data centers, but for the data centers that are being built in Asia that are not going to be subject to U.S. tariffs. Those are AI data centers for Asia.
Absolutely. And John, it gets to this idea, though, too, when we talk about how all this stuff gets dispersed. I mean, meaning on a geographic level here. Is the U.S., I guess from an economic standpoint, can that sort of cost benefit be better here than somewhere else?
That's a really great question. I think to answer that question, we need to start to see some of these AI applications really start to generate value. And Jensen, in his speech at CES and in his interview with you, is really highlighting a couple of those. And where we're seeing value that's being created already. If you live in San Francisco or Phoenix or LA, you can take an autonomous car ride. And if you're in manufacturing, you're already seeing the development of robotics and how that's going to impact manufacturing going forward. Those are 2 examples of maybe the first AI applications that are going to be massive. Mm-hmm. If you combine the AI in robotics and the autonomous driving, that's potentially a multi-trillion-dollar AI market, as Jensen noted last night. Yeah. And I think that's where a lot of value is going to get created. You're going to start to see the ROI on these massive investments.
And we're in conversation right now with Jon McNeill over at DVX. And I just want to point out to our viewers, we have some breaking news crossing the wire on Amazon regarding data centers. Amazon Web Services, of course, the big profit driver of that company, saying that it's going to invest $11 billion in the state of Georgia, primarily to support cloud computing and AI technologies, i.e. Data centers here, saying it's going to create at least 550 new high-skilled jobs. And John, I want to kind of pose this question to you. I mean, this is a lot of money for any company, but the idea that it's just concentrated just on Georgia, and we've had other announcements by Amazon Web Services of investments in other states. You have other big companies like Microsoft and a few others also making these announcements. This is a lot of money, John, going around right now. You think that's going to continue, or more importantly, do you think that's going to increase from what we already know?
I think when you see the announcements from Amazon like this, from Microsoft the other day, where the heart of Microsoft's announcement was that they were going to invest at least at the pace that they're investing in now. And this is a real arms race in the sense that the compute is needed to solve these problems. Somebody's got to provide the compute, and the hyperscalers in the form of Amazon, Google, and Microsoft are at the forefront of this race. And so you see these really substantive and material CapEx announcements that I think are going to continue and probably grow.
Jon, we'd be remiss if we didn't press you more on electric vehicles, given that you were the former president over at Tesla, and we talked about self-driving vehicles. That's going to be a 2026 story, if you believe Elon Musk's projection for robotaxis and the production of that. Before we get there, though, we need to right-size the EV market first. And the legacy car makers, they're paring back production, and in some cases they're merging, like Nissan, Honda. Does the cost-cutting for this industry peak in 2025, or will this be a multi-year process, something that'll take us into 2026, 2028?
It's a great question, Scarlet. And I think if you look at the automotive industry globally, as a whole, there's about 20 to 25% overcapacity in the industry. So that means that we're going to continue to see consolidation of capacity, and not just in 25, but in years beyond. To answer your question, I think what's at the heart of Honda and Nissan coming together is they've really missed the boat on EVs and cost reduction. So they're in a very difficult spot to go it alone, and need to come together to really take significant cost saving steps. And I think we're going to see more of that, not less of it, because the Chinese competition is real. They've demonstrated a very different cost level. And internationally, the automotive manufacturers are going to have to step in to both EVs and cost cutting.
Given the new administration coming in here in the U.S., Jon, do you think we're going to see an acceleration of this, meaning the government will sort of clear the way for this to happen faster?
I think to the extent there's consolidation in the U.S., it'll be easier, I think, under a new FTC chair for sure. But there are several American companies, including GM and Tesla, that are in good shape to battle both on the low cost and the EV front.